Don't skip, don't tab out, don't watch later. Because what I'm about to walk you through may be the clearest warning sign we've had in decades that the line between real assets and paper promises is thinner than anyone wants to admit. Yesterday morning, in the US Senate hearing room, a senior executive from America's largest metals futures venue raised his right hand, swore an oath, and answered one question in a way that instantly changed how traders around the world are thinking about silver. Not because he shouted, not because he confessed to a crime, because, under pressure, he finally said the quiet part out loud. If too many people ask for the metal at the same time, the system can't deliver. Today is Thursday, January 22nd, 2026. You're watching The Quiet Ledger. And for the next few minutes, I want to take you inside what happened, what it means, and why the consequences are already spilling into real factories, real supply chains, and real portfolios. But to understand yesterday, you need to understand the weird, almost magical trick the modern commodity market plays on your brain. It makes you feel like you own something you've never touched, stored in a vault you'll never see, governed by rules you've never read, and that illusion held up until someone forced the issue. Let's start with how silver ownership actually works for most people. When someone says, "I'm buying silver," there are at least 4 different things they could mean. Number 1, physical silver in your possession coins, bars, rounds. You can hold it. You can move it. You can lose it. That's real ownership. Number 2, allocated storage-specific bars assigned to you, stored under custody. You pay fees, you get serial numbers, and in theory you can request delivery. Number 3, unallocated accounts. An IOU. You're a creditor, not an owner. You don't own bars. You own a claim. Number 4, paper exposure ETFs, futures, swaps, structured notes. You may get price exposure, but delivery is either difficult, expensive, or practically impossible for regular investors. Now here's the uncomfortable part. The global market price you see on your screen is primarily discovered in the paper world, not the physical world. Price discovery is dominated by leverage, not metal. By contracts, not bars. By margin, not mining output. And that's not automatically fraud. It's how futures markets are designed. They let producers hedge and consumers lock in costs. Most contracts never intend delivery, but there's a difference between most people don't ask for delivery, and the market could never handle delivery if confidence breaks. That difference is the entire story, because when the public believes the vaults are full, paper claims feel safe. When the public suspects the vaults are thin, paper claims start to look like a bank run waiting to happen. And on Tuesday morning, a trigger was pulled that turned suspicion into a headline. Here's what changed. On Monday, yes, a federal holiday, with markets closed, an executive directive from the White House quietly instructed Treasury and oversight staff to perform a verification sweep of strategic and exchange-linked metal inventories held in U.S. regulated facilities. The reason given was critical materials readiness. The effect was simple. Auditors showed up with badges, documentation authority, and a mandate to reconcile reported inventory with what was physically verifiable. On Tuesday, January 21st, they entered multiple vault locations connected to exchange deliverable supply. And according to briefings that circulated through regulatory channels that afternoon, the numbers did not line up. The widely circulated inventory dashboards had suggested something on the order of roughly 300 million ounces of silver in various categories tied to deliverability and market functioning. But what auditors could confirm is immediately available, deliverable, and not encumbered by overlapping claims was far smaller. Tens of millions, not hundreds. That gap is where the chaos begins, because the market hears missing and assumes theft. Sometimes it's not theft. Sometimes it's structure. Silver in these systems can be reclassified between categories, pledged as collateral, allocated in one ledger while referenced in another, or counted in ways that make sense to lawyers and clearing members, but sound insane to normal people. Then came the Senate hearing. It was scheduled fast. It was framed as market stability oversight. And it pulled in a key witness, Ethan Cole, a senior vice president overseeing metals custody and operations at the exchange's clearing ecosystem. The first half of the hearing was procedural, almost boring, until Senator Alvarez asked the one question every viewer at home would ask if they understood the stakes. If every contract holder demanded delivery in a short window, can the system meet the request with physical metal? Cole paused, asked to confer with counsel, and then answered with a sentence that will be replayed for months. We can meet delivery under normal participation assumptions. Under full conversion conditions, physical availability will not match total outstanding claims. Translation, in a stress event, there isn't enough silver for everyone who thinks they have a right to it. Then came the follow-up, and this is the part that hit like a hammer. What percentage could you meet? And after another long pause, Cole gave an estimate framed as a range, heavily qualified, but the number that escaped into the world was brutal. Low teens. Call it 12%, give or take. meaning for every 100 ounces of paper exposure that traders believe can become metal, only around a dozen ounces are realistically ready to walk out the door without a fight. When that audio description started circulating, it didn't matter how many footnotes existed in the documentation. It didn't matter how many definitions could be debated. The market heard one word: shortage. The reaction didn't wait for the morning bell. In the overnight session, silver ripped upwards so fast that liquidity thinned out and spreads widened like someone pulled the oxygen out of the room. Quotes jumped, stops trigger, market makers backed away. And within minutes, we saw halts and volatility controls kick in. Not because silver got more valuable in a calm, rational sense, but because the market suddenly had to price a new risk: counterparty performance risk. That is a different animal than inflation. Different than industrial demand, different than mining supply. It's the risk that the thing you bought is not deliverable in the form you assumed, at the time you assumed, under the rules you assume. Then the physical market did what it always does. When paper gets loud, it stopped cooperating. Dealers widened premiums. Some paused online sales entirely. Large wholesalers started quoting "subject to availability" language that you usually only see in crisis periods. And abroad, the divergence appeared. In some hubs, the screen price was one thing. The "get it to me this week" in size price was another. That divergence is the tell. When the market is healthy, paper and physical prices rhyme. When trust breaks, they decouple. And as that decoupling spread, the story stopped being about traders and became about factories. Because silver isn't just a shiny trade. It's a hard input. Here's where this turns from interesting finance drama into economic disruption. Silver sits inside solar paste, high reliability solder, medical equipment contacts, precision switches, defense electronics, data center components, and more everyday devices than most people realize. When procurement teams can't lock supply, production schedules don't adjust. They break. By Wednesday morning, industry reports started hitting the wires. A European renewable supplier issued a force majeure notice to a downstream customer, citing inability to secure conductive metals at contracted terms. An electronics assembler in East Asia reportedly suspended a line due to shortages in silver-bearing solder materials. The defense subcontractor trade bulletin mentioned priority rerouting of certain materials to government channels. Now, those headlines are always messy in real time. Companies don't like admitting supply trouble. Governments don't like admitting strategic vulnerability. And traders don't like admitting how leveraged the system is. But step back and look at the logic. If a market has been running on the assumption that only a small fraction will ever ask for delivery, it can function with a small deliverable float. Until one day, participants decide they don't want exposure, they want possession. That's when the scramble begins. And the scramble is lethal for one group in particular: concentrated short sellers. Because if price rises while physical tightens, shorts don't just lose money, they lose optionality. They can't easily go find metal if the supply chain is dry. And if a small number of large institutions are holding a meaningful share of the short exposure, their problem becomes everyone's problem: clearinghouses, counterparties, lenders, and potentially the central bank backstop system. That's why, behind the scenes, the most important meetings this week are not happening on TV. They're happening in risk offices, because the question is no longer, what is silver worth? The question is, what is a claim on silver worth? So what does the government do when a strategic input looks constrained and a major pricing venue looks fragile? Three things, almost every time. First, they investigate and message stability. You'll hear phrases like review, oversight, coordination, and orderly markets. That's not theater, that's containment language. Second, they pressure the system toward cash settlement and away from physical stress. If too many people demand bars, the system can force settlement in dollars. That keeps the plumbing intact, but it openly admits that paper is not the same as metal. Third, they prioritize industrial and strategic access. That can mean strategic purchasing programs, export restrictions, priority allocation, or quiet agreements that certain buyers get first claim on supply. And if you're thinking, wait, can they really do that? Yes. When national security and industrial continuity are invoked, normal market ideals become optional. Now add one more element: the political incentive. No administration wants headlines that read, "Phones delayed, solar production halted, or defense supply chain constrained." So the path of least resistance is stabilize public price signals, protect critical industries, and quietly push financial holders toward cash outcomes. That is why, in a scenario like this, paper holders can win on price and still lose on reality, because you may get paid, but you may not get the metal. And if the world decides silver is scarce in the form that matters: deliverable, unencumbered, in hand, then the price that clears the market may be far above the price you were shown during the trust era. Not because someone decides it, because rationing is what price is. If supply is tight and demand is non-negotiable, The clearing price rises until someone stops buying or someone starts selling. Now let's make this personal, because none of this matters if it doesn't touch your decisions. If you own physical silver that you can access, meaning it's in your possession or truly allocated under clear title, then you're not holding a trade. You're holding optionality. In a dislocation, optionality is power. You can sell into premium spikes. You can hold through volatility. You can avoid counterparty risk. But if your silver exposure is primarily paper ETFs, futures, pooled accounts, unallocated statements, then your real risk is not just price movement. Your risk is settlement terms. In a stress event, the rules that matter are not the ones you assumed. They're the ones buried in prospectuses, exchange rulebooks, and emergency authority clauses. And those almost always say some version of, under extraordinary conditions, we may settle in cash. Cash is not evil, but cash settlement at a time chosen by the system, priced by the system, is not the same as metal in your control. So here's the framework I want you to carry forward over the next 30 days as this develops. 1. Watch premiums, not just spot. Premiums are the truth serum of physical markets. 2. Watch delivery conditions and rule changes. If you see margin rule shifts, position limits, temporary measures, or new settlement guidance, that's the story. 3. Watch industrial procurement headlines. When manufacturers panic, it's not a chart pattern, it's a constraint. And 4. Don't confuse I have exposure with I have supply. They are different things, and this week made that difference loud. We are entering a phase where trust will be repriced, not gradually, violently. And when that happens, the biggest surprise to the average investor is simple. The screen can say one number, and the real world can demand another. I'll be tracking the White House briefing scheduled for later today, the regulatory response, and most importantly, any confirmation of how deliverable inventories are being defined going forward. Because if the market collectively accepts that only a small slice of claims can become metal, then the age of easy paper silver is over. And the next era won't be driven by opinions. It will be driven by what can be delivered. This is the quiet ledger. Stay sharp, stay liquid, and don't outsource your understanding of what you actually own.